welcome in to this week's Freightonomics, and we have a special guest host this week. Tony Mulvey, of course, head of our research department here at FreightWaves, is going to fill in for Anthony Smith, who we haven't canceled out completely yet.
No, he gets to do the fun stuff. He gets to be in New Orleans.
Oh, he goes to New Orleans, gives some talk, but he didn't even like food, so I don't even know why he would go down there if you don't like food. Zach Strickland, head of freight market intelligence here at FreightWaves, and we are really, I think we've got, again, too much content to talk about this week. I mean, the consistent theme of, I guess, the economy, the freight market, goods economy, et cetera, is, economically speaking, are we at a bottom yet? Yeah. And there's still a lot of data that says we are not quite there. A few conflicting signals. This is just an ongoing debate, but we're going to tackle that and more on this week's show. Yeah,
but as you start every episode, right? Looking at the freight market in two, Zach, are you ready to go?
I mean, if y'all are ready, let's get it on.
Let's go.
Let's give everybody the data to start their way. So kind of send, Tammy.
All right. In 3, 2, 1.
All right. First up here, we have the OTVI. If you haven't been paying attention, this is the chart that I'm going to lead with for the foreseeable future, because demand is the most important thing to watch here in the next few months, because this is where we're really going to see if the market bottoms or not. Once this starts ticking back higher, or we see some seasonality return in March, like I talked about, that's going to be the sign that we actually might have already hit a bottom. Right now, though, OTVI, you can see we had a little bit of an uptick at the end of January and early February. It's starting to go back down again. So I'm not quite there yet. I'm not going to call a bottom. We're still a few percentage points above 2019 there in the orange, or 2020, I should say, there in the orange, which is the last normalized year. If you call it that, we're still not quite there yet. Not going to call a bottom, especially here in February. It's a little soon. Let's go to the next one here. Speaking of demand, IOTI, Yachty. Tony and I talked about it this morning on FreightWaves Now. You can see this is another indicator of demand. This measures bookings coming from all over the world, container volumes coming from all over the world into the United States. This is taking a pretty big dive. Now, a lot of that has to do with the fact that Chinese New Year, Lunar New Year did occur, and that is influencing this index at the moment, but it's not changing the overall trend line, which is downward. And once we exit the Lunar New Year period, which is about 2 weeks, this is going to be a key index to watch to see if shippers are really that optimistic about rebuilding inventories. Let's go to the next chart. OTRI versus NTI. So tender rejection rates versus spot rates. The least interesting chart that I have to talk about right now. They are both flatlining. Now, rates do look like they're trying to form a floor, but they're still not quite there yet. So still a little ways to go potentially on the spot market. Last but not least, the NTIL on our last chart here. We're all over the place. The white line, we still have room to fall. If we do get all the way back down to that orange line, things will be trouble for carriers.
You are not wrong there. I think if we get to that level, it's going to be bleak, and it's already not a great outlook, right? And
it's not great.
So there is room to fall. I think the one interesting chart, and like you said, we talked about it earlier this week, or earlier today, IOTI. I mean, it looks like it's spiraling out of control when you factor in certain things. I know, obviously, we're going to talk a little more about that, but I think that's the chart to pay attention to, because it is that upstream look at future demand here in the U.S. So.
Yeah. Go ahead and pull it up, Tanner. The way to, this is my big upstream signal with the IOTI, projecting forward. This is a good indication of shippers' activity. And we're going to talk about some earnings calls today where a lot of their customers are telling them, hey, we expect to rebuild inventory. We expect we're going to be back. This is the chart right here that you need to look at to show when they're actually doing it. Because they are doing this. They are creating this index. All these companies are creating this index. They are placing orders for containers. So when this thing starts moving, that means they're actually doing it.
And that's what we're waiting on, right? Is to see that actually happen. And I mean, that's what's interesting when, as you said, we'll talk about earnings, but you hear management commentary across the board on the transportation side that, hey, we're going to see the back half strong. Well, I look at that and it's like, this is stuff that's going to be moving in the back half. or middle of the year, right?
Yeah, we're talking probably, typically a 6 to 8 week lead time before it's actually moving. The inventory's supposed to be sold in the space. So it's a little early
April
to call.
to May, when that start really.
This is our seasonal freight, though, for March and April, that it's just not. I mean, and April's kind of a soft month in general, but it looks like inventory's still not quite right. And this is a concerning chart. And like we mentioned with the spot rates there, they're finding a floor, but I think they got a little bit further to go in terms of freight market activity. We're still not quite fully vetted in terms of carrier desperation.
Yeah, I mean, are we going to see the 40-cent drop that we saw in a month span in 2022? I don't think we're going to see it. No, not at that rate for sure. But I mean, I looked at the NTI forecast yesterday with Tanner, and it definitely showed that there's room to fall within the next month. So
we could. There's a lot of upstream signals, specifically from our maritime data, that suggest that we have not hit the bottom yet. But spot rates are flooring right now, and that may just be a little bit of carrier discipline showing up. We know that they're not having great utilization comparative to last year, so we'll see. Time will tell. So moving forward. We talked a lot about the maritime side. Let's move into newsonomics and discuss some of the top and most relevant stories. And of course, the theme of a lot of these stories is our optimism for the third and fourth quarter this year warranted?
Yeah.
Are we seeing anything that gives us reason to expect that? And we talked about these customs so much when we're talking about forward looking, because that's the stuff that really does tell you the supply chain and ops people that are ordering the goods. They're the ones placing these orders. If they feel good about their marketing and their customers, which they're not always right. They've been pretty wrong for the last 2 years, and it's not their fault. It's hard to predict these type of environments.
As I say, we've seen, demand planning's become so difficult at a shipper, especially around the consumer, right? I mean, consumer behavior changed throughout the past 2 years.
Significant.
And it's changing now, right? It's reverting back to what it was. I mean, we talked about it off air. I mean, this shift in goods to services,
absolutely.
We're still a services-led economy, typically.
70%.
Yeah, we were 70% goods in the past 2 years, and now, so we revert,
now we're shifting back.
Yeah, so it makes that demand planning that much more difficult on the supply chain.
Extremely difficult. And the first article, Greg Miller, of course, definitely anybody interested in this absolutely has to read his articles. January imports up versus December, but February is looking weak. And he states February could be the worst month since May of 2020, according to Port Tracker estimates. So just think about what that statement is. May of 2020 may not mean anything to people that don't follow maritime. This was the bottom of the COVID shutdown, right before everything got super hot again. This was when everybody shut down in April and May. The economy was dead, flatlining. And we're seeing, they're predicting February to be that bad.
Yeah. And it's not a surprise when you look at our trade partners and what's coming out of their
Lunar New Year.
Lunar New Year has that impact, and it's regional over in the Far East. But I mean, still, it doesn't seem like, we talked about it a lot, that things are they going back to 2019 levels? Well, this kind of shows that, hey, 2020 was so bad. Well, in May, 2020 was so bad. We're going to hit that level. What was that level compared to 2019? I'm going to guess it wasn't that much. It was probably worse than 2019.
It was.
So guess what? If we're headed back that direction, we're getting back to 2019, which, if you remember it, was not the greatest year for freight.
It was terrible. It was an awful year for freight. And relative to supply, I should say. It's always in relation, because the demand in 2019 was greater than that of 1946. But at the same time, it's, compared to the years prior, it's very soft, because you're talking about capacity and how available is it? Does it feel good? Are there any distractions or disruptions? And that's really what we're talking about here. So I'm going to pull up the customs chart to put this into perspective. So the article talks about January was actually up over December. Well, if you look at customs here, we had a pretty big dip in December.
Yeah.
If you look at that white line there, that's our current year. In the previous 2 years, in blue and green, we're well below those, but the idea that we're better than December isn't, I don't think that's a positive.
No, especially, I mean, we've talked about it, I mean, on the transportation front. If you think about December, you lose a full week of productivity. Guess what? They lose it at the port too, right?
Yeah.
So it's, you're comparing basically 4 full weeks or 4.5 full weeks to 3 weeks. It should be better. Right? So like,
and I guess there is a positive takeaway here in the way that if you're looking at that white line, it's not falling off a cliff like that bookings data is, like we just showed you. Now, bookings, of course, the difference here is that bookings data, the IOTI, is about 6 weeks upstream of stuff that actually clears, or it's probably, I guess, 2 to 3 weeks if you're talking the West Coast. But for stuff that actually gets cleared at our ports, this is what we're looking at right now, is the stuff that has been cleared for transport at the ports. The IOTI is much further back or upstream in the supply chain.
Yeah, with customs data, I mean, it's kind of at the mercy of as they clear them, right? Some days are more productive than others and things like that. And you can see it in the index itself, right? Just the volatility on a day-to-day basis. So
yeah,
it's more of, you got to pull out the long-term trends there as opposed to looking at how things change on that day-to-day basis.
And Port Tracker, of course, is predicting that this index to fall pretty quickly. So I want to pull up another chart here. This came out of the Wall Street Journal, but it's Census Bureau data. Percentage of U.S. goods imports, reflective of the trade, kind of a reminiscent. We're still not great with China, where most of our goods come from. We're seeing a transition, and it's really, you can start to see it. This is the percentage of goods imports coming from various sectors around the world. China on the decline, that orange line there, China falling sharply. Other Asian countries, I don't know if this is a huge surprise to me, but really taking over.
Yeah, I mean, we've
in terms
heard
of percentages.
I mean, you look at manufacturers like Apple moving their manufacturing out of China into other countries in Asia. It's not a surprise to see that kind of shift. I think the interesting one is you've seen Canada kind of ramp up there. Mexico's pretty stable, but we hear about nearshoring and reshoring. Like, it hasn't happened, or it might be in the act of happening, but it hasn't actually taken hold yet. And I think that's a trend to pay attention to as we move forward.
Yeah, and then so obviously everybody is very up on Mexico and Canada, and they are moving higher. But that's actually Canada. If you look at Canada, that's actually up off of being down. So they've been a higher percentage in the past. Mexico, obviously, on a trend line, much higher. And really the big takeaway for me is the divergence of Asia excluding China and China. I think that's your big takeaway, is that they're actually transitioning to other Asian countries.
But it still makes the Trans-Pacific trade as a whole is still vital to the U.S.
Absolutely.
Right? It's getting away from the single country.
Yeah, Mexico does not have the, the infrastructure there. It took China decades to get to where they are. So moving forward, let's go into Q4. Werner Q4 Beats 2023 guidance has some hurdles. Although Derek Leathers, CEO, does put in there that he has optimism for the future. And this is based on his conversations with his customers. The back half setup is for us to get back to a world of inventory replenishment, peak freight movements, et cetera. And that's what Derek Leathers says. And I don't know that he's wrong in that sentiment, but let's break down their earnings, see if there's any takeaways here, Tony. So for me, this looks like a fantastic return from a Q4, from a carrier perspective, right?
Yeah, I mean, especially in the environment we were in. I mean, you look at the consolidated operating ratio of 240 basis points worse. You have to factor in fuel prices are that much higher, labor expenses, equipment prices, all of that's higher. And you saw a 240 basis point decline. You're still right in the mid 80s, which is pretty healthy.
Yeah, you went from an 81 OR to an 84 OR. That's not great, but it's not terrible.
Yeah, I mean, it would have been more concerning if that got up into the 90s, right?
Yeah. I mean,
like, that's a big. And now I look at this, and you see again truck count up, but they were active.
They were active investors. They purchased Baylor and added 200 trucks to their balance sheet here. So I don't, I was critical of, I forget who it was last week, but they added, or Night Swift added some trucks. But who am I to tell Night Swift how to operate? They still had like an 80 OR, but adding capacity in this environment feels like a bad decision. But these are big trucking companies. They have huge cash flow surpluses left over from the pandemic. So acquisition, that's the right move here for Werner.
It's different than just going out and buying 200 trucks. You're building, they may have access to customers and things like that. You're buying something. You're not buying just capacity.
Yeah, they're getting customers too.
Yep.
They're growing responsibly. It's not like they bought trucks and then have to go and find freight for it.
Yeah, right. You're adding revenue to them automatically without having to go and fill them and seat them at that point too.
Exactly. That takes a lot of time. And this is not the environment that you want to go through that process. Their logistics sector also showed a pretty decent uptick. Now, however, they did also make an acquisition there of Reed TMS, which boosted their revenue. If you adjust for that acquisition, their margin decline was actually 17%. So it's there's a little bit of noise there. And again, I wouldn't be critical of any logistics sector or logistics company for seeing declines year over year. You're talking about the most bountiful brokerage environment possible in Q4 of 2021 to probably the worst in 2022.
And again, these are logistics arms inside of an asset-based carrier, right? It's a different, what they're trying to accomplish overall is very different than pure play brokerage, right? I mean, at the end of the day, you need to keep assets moving. And that's the name of the game. And that's why you look at carriers and their brokerage arm is it's not necessarily a growth.
It's not
arm.
A pure brokerage move where you're just trying to expand margin, get a bunch of transactions in play. No, you're there to support the mothership for the most part. And that's a totally different mindset than going out there and just pulling rips.
Exactly.
So again, we expect that especially on the asset-based side in a Q4 like we just saw.
Yeah, and right now it's kind of this prime opportunity in M&A activity, right? I mean, they're flush with cash. They can go buy things. People are trying to make exits.
And honestly, optimism, you just had a pretty good beat. I'll allow it. I'll allow it in that situation. So LMI came out. And of course, we don't have Dr. Z on this week, but at some point, I hope that we can get him on to discuss some of this because this release probably is more interesting to me than just about any other release that we've covered here. And Todd Maiden, I believe, writes this: transportation metrics show early signs of firming in January is the title of this article. Now, there's a few call-outs here, Tony. We were talking about this before the show. Manufacturers are optimistic about the potential for future order sales, particularly as transportation prices come down. Doesn't really tell me that it's there. They're optimistic. Okay, you feel good about it. That's fine. Let's move down. Upstream firms also had higher expectation for future warehouse prices, 12 points higher than retailers. That's not great.
I mean, that's their cost, right?
Their costs
they're expecting their costs to go up.
They're expecting warehouse prices to expand 77.1 for future expectations, which is extreme expansion. So your inventory costs are now expanding faster than inflation. Not a great sign for inventories. Now, one of the things to take away, inventories are much lower now than they were in Q3 of last year. And it seems supply chains are coming back to life with the goal of replenishment. I don't know that I agree with that based on the data.
This is the one that,
this is where I start to get a little bit wonky. Inventory levels report a 62.5, which is up 5.2 points sequentially off of December. This is the most concerning value on this report to me, because anything over 50 for the LMI is an expansion. So throughout probably most of the third quarter in the last month, we were seeing this fall from like mid 70s all the way down to the mid 50s.
Yeah.
It was 56.2 in December. This ticked up to 62.5. That means inventories are now growing.
Yeah, they never stopped growing, right? They grew. They may have grown at a slower pace, but they never entered that contraction period, right? Like that's the part. Yeah, that reading's down 8.6 points year over year, but they're still growing, and they're growing at a faster pace than what they were. So that's where it's like I can't say that they're lower than they were in Q3. They're still growing, and if they were growing in Q3 and kept growing the whole way through, well, did they actually get smaller?
It doesn't look like it, according to this. So, yes, we know that they're in better position for sure, but that's relative. The last point of this that kind of also, and I will temper this with the idea that this could be potentially a good sign that we are seeing replenishment of seasonal freight.
Yep.
We still have inventory that's backlogged and left over from the pandemic that they don't need. So maybe they are ordering some replenishment freight right now for future demand that they just don't have the goods for. That's the positive takeaway for me. However, warehousing capacity contracted for the 30th straight month, 46.4, the longest run of contraction that we've observed for any of our metrics during the 6.5 years. So inventories grew, warehouse space contracted. This is still, we have not bottomed.
No.
We are not at the bottom yet. That's what this is telling me. I don't take, even though there could be some positive interpretation in terms of what I just said, in terms of like, but they haven't gotten rid of all this old inventory that they're expecting to now cost them a lot more in the future.
Yeah. Yeah, I mean, what are they gonna, I mean, that's gonna be the key is like, how do they offload that inventory, right? Like, I get the replenishment part, but you have to get rid of some of this unwanted inventory. And I'll give retailers credit. They've tried to do that. But does the consumer want to buy this stuff that's kind of out of date, obsolete? And do they have the money to do it?
Yeah, and it's going to cost more in the future to warehouse this stuff.
Yeah.
If they miss their demand forecasts again, their costs are going to be even worse. So this is not great for me. We're definitely not out of the woods. So I want to move forward. The Fed funds situation. We just had a quarter, and they're signaling for more. And I want to pull up this chart of the Fed funds just to put this into perspective. We talk about it all the time. It's extremely important to see historically the past, I guess this is 30 years of the federal funds, and every line on there is the recession. We haven't really seen the Fed raise interest rates this fast before.
Yeah.
And if you can see this trend line here, they raise it until they don't. They basically raise it until there's a recession. And the rate of increase here is what's most concerning to me. And the fact that we're talking about the cost of inventory and inflation. This actually has a backdoor impact on inflation when you're talking about consumer debt.
Yep.
And now we're taking away we're actually increasing the cost of the goods they've already bought.
Yes.
And here's the caveat, without incentivizing saving.
Yes. That's the key, right? I mean, I looked at it, average credit card interest rate now is 20%. It's gone from 15 to 20, and that was from Q2 of last year to Q4, because that number is quarterly. But I mean, those costs, if consumers are not paying off their card, and you see that because if you look at outstanding revolving credit, right, those are balances that are staying on. It doesn't count for those people that pay off their card every month.
Right.
It continues to get more expensive. It's like you said, it's the goods they've already bought are getting more expensive than they already were, right? Yes. They were buying goods in this inflationary period. Now they're getting hit on the other side, and it's just a squeeze, and it doesn't give them the opportunity to continue to spend more money because...
And we haven't trained them to save.
Yeah.
We haven't trained them to invest. We haven't trained them to save. We've trained them to spend, economically speaking. And so they've learned some bad habits, and they're not fully aware of what is occurring on the back end.
Yep. And I mean, you look at the savings rate, it's what, 2.1%, 2.2%. It's like near historic lows. And
We are always a little prisoner of the moment. And this is why I'm concerned about that Fed rate going vertical like that, is that it's too dependent on right now.
Yeah.
We dismissed inflation as an economy for 2 years when we had all the math said it's going to happen. And we're still kind of holding on to it.
Yeah, and
because jobs are good.
It's yes, and this is the jobs thing. I think is an interesting one because look at where layoffs are happening. They're in tech. They're getting severance packages. They're not having to go on unemployment right away. You're not seeing the labor market because, I mean, they're really not unemployed.
Yeah, we're by no means done with this downward movement. I know that there's reasons to be optimistic and certainly don't want to be doom and gloom, but I'm not calling it.
Yeah, I'm not either.
All right, well, that has been this week's episode of Freightonomics. Hopefully it was informative for you. Anthony Smith probably will be back next week unless we lose him in New Orleans. In the meantime, have a great